The shiny metal had another month of strong performance. Gold prices surged by close to 11% through the month, one of the strongest monthly performances in the last decade, and through the last year moved up close to 40%. In fact, gold ETFs globally saw one of the highest inflows in the first half of the year. What is more interesting is beyond the noises of the price movement is the signal which the gold price movement seems to be conveying. The question is what it is. Is it the fear of the pandemic? Is it talking about a sustained low real interest rates? A deflationary situation? Well, we do not know, and only time will tell. But as we grew up and we were told an old adage that all that glitters is not gold, but turns out for the financial markets, all that glitters is gold. Hi everyone, my name is Rahul Pal and I head the fixed income at Mahindra Manulife Mutual Fund. I'll be talking a bit about the markets, and I'll also be talking about the outlook for the debt markets, also focus on the monetary policy which was announced today on the August of 6th, and also talk about the scheme strategies. First, broadly about what happened in the debt markets. Through the month of July, the gilt yields were stable and with a benign bias and fell off by close to 5 basis points. After the monetary policy announcement, the gains through the month were given up today after the monetary policy announcement of an unchanged reverse repo and repo rate cuts. The corporate bond curve, the AAA corporate bond curve, actually dipped very sharply through the month. It fell close to 25 to 30 basis points and leading to a very sharp drop in credit spreads. As liquidity was adequate, we saw a very stable money market curve with a marginal uptick in rates. A great performance in terms of the dollar rupee appreciation, and FPIs unfortunately continue to remain having a very low participation, and they kind of move money out of the Indian debt markets. On the outlook ahead, well, the Monetary Policy Committee met today and announced an unchanged policy movement. There was absolutely no change in the reverse repo or the CRR rates. That was something which the street was expecting. But what it did talk about was a continued accommodative stance and the fact that to use the monetary measures as and when the situation presents itself, and when they see the fact that inflation has been actually on the downtrend, something that the Monetary Policy Committee members will be keenly looking at. In terms of the gilt rates, while the gilt yields have moved up by 5 basis today, we think gilt has a strong tactical play, but over a long-term period, we are not so favorable in our gilt positions. We think the fact that the best returns are past us, and we'll be very cautious in our approach to gilt. The only piece of the yield curve which affords some of interest is the spread between the 5-year and the 10-year of around 80 basis points, which is almost at a 20-year high. It will be a very interesting play through the portfolios. The credit spreads have shrunk very dramatically, and we think again on the AAA credit spreads, the best is behind us, and they are very richly valued. The only point of interest probably is in the non-AAA, and we have seen some recent buying by the banks for the non-AAA assets, which gives us to believe the fact that going ahead, they look very interesting in terms of the spreads, which still are quite high. The shorter end of the curve, we feel will remain very benign, liquidity being adequate. As far as the RBI's movement going ahead, and they've clearly talked about accommodative stance continuing, and while they were looking out for inflation, but something which keeps on as an investment team we keep on looking over is the rise in the commodity prices, and they generally haven't had a good outcome on the Indian bond markets, and generally the Indian bond markets have had a lag effect on the rising commodity prices, so something we're extremely careful about. In terms of the strategies on the scheme, nothing's very changed through the last month. Mahindra Manulife Low Duration Fund has an average maturity of close to 330 days. The YTM of the portfolio is 5%, and we intend to maintain it that way through the future. The Mahindra Manulife Ultra Short Term Fund has an average maturity of close to 160 odd days, and with a YTM of close to 4.40. That's also a steady state strategy that we are going through. And in terms of both our hybrid schemes that we run, the portfolio modified duration is close to 4. And as we go ahead, we think we will move the portfolio modified duration of both the hybrid schemes a bit further down. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.